Welcome to our channel. In today's video, we're diving into a critical topic that could impact your financial future. The top 10 cities poised to experience a market crash in 2025. As we explore the economic trends shaping these urban landscapes, we'll provide you with valuable insights into the factors driving potential downturns. From rising inflation rates to shifts in employment patterns, understanding these dynamics is essential for anyone looking to navigate the real estate market. Our goal is to engage you with informative content that highlights the risks of investing in these cities. So, whether you're a seasoned investor or just starting out, stick around as we uncover the cities you might want to avoid in the coming years. San Francisco has long been a tech hub, but the volatility of the tech industry is raising red flags for its housing market. With major companies facing layoffs and stock fluctuations, the demand for high-priced real estate is beginning to wane. Additionally, the rising cost of living is squeezing local businesses, making it harder for them to thrive in an already competitive environment. As expenses continue to climb, many residents are feeling the pinch, leading to a potential exodus from the city. Furthermore, recent trends show a slight uptick in unemployment rates, which could further dampen consumer confidence in spending. These economic indicators suggest that San Francisco may be on the brink of a market crash, making it crucial for investors to tread carefully. New York City is facing a potential market crash, largely due to its real estate bubble and the unsustainable growth that has characterized the market in recent years. Skyrocketing property prices have made homeownership increasingly unattainable for many, raising concerns about a correction. The rise of remote work has also significantly impacted commercial real estate, with many businesses downsizing or closing their physical offices, leading to increased vacancies and declining rental income. Additionally, economic disparities in the city are widening, affecting consumer spending patterns. As lower-income residents struggle to make ends meet, luxury retailers and high-end services may see a drop in demand. These factors combined create a precarious situation for New York City's real estate market, signaling potential trouble ahead for investors. Los Angeles is grappling with several economic challenges that could lead to a market crash. The entertainment industry, a cornerstone of the city's economy, has faced significant instability, especially with shifts in consumer behavior and the rise of streaming services. This volatility creates ripple effects, impacting jobs and local businesses reliant on the industry. Additionally, the housing market in Los Angeles has seen unsustainable price increases, making homeownership increasingly out of reach for many residents. This situation raises concerns about a potential correction as affordability issues mount. Furthermore, the threat of natural disasters such as wildfires and earthquakes poses risks to local economies, disrupting businesses and driving up insurance costs. Together, these factors create a precarious economic landscape for Los Angeles, signaling caution for potential investors. Miami faces several risks that could trigger a market crash, primarily linked to climate change. Rising sea levels and increased hurricane activity threaten property values, making potential buyers wary of investing in vulnerable areas. This environmental uncertainty can lead to a decline in demand, impacting the overall housing market. Additionally, the influx of foreign investments has brought significant capital to Miami, but this volatility can create instability. If global economic conditions shift, these investments may dwindle, leaving the market exposed. Furthermore, Miami's tourism industry heavily relies on economic stability. Any downturn could reduce visitor numbers, affecting local businesses and jobs. Together, these factors create a precarious situation for Miami's real estate market, urging investors to proceed with caution. Seattle's economic landscape is showing indicators that suggest a potential market crash, primarily due to its over-reliance on a few major tech companies. While these giants have driven growth, any downturn in their performance could significantly impact the local economy and job market. Additionally, the rising cost of living is putting immense pressure on residents, making it increasingly difficult for many to afford housing and basic necessities. This financial strain can lead to decreased consumer spending, further affecting local businesses. Moreover, with home prices soaring, the housing market may be due for a correction, as affordability issues push potential buyers out of the market. These combined economic indicators signal caution for investors considering Seattle's real estate opportunities in the near future. Austin is experiencing rapid population growth, which, while often seen as a positive, is placing significant strain on local resources and infrastructure. This influx of new residents has led to skyrocketing housing prices, largely driven by the tech industry's influence in the area. As more tech companies establish themselves in Austin, demand for housing has surged, pushing prices beyond what many locals can afford. However, this growth may not be sustainable. The potential for economic overextension in startups raises concerns about job stability and market resilience. If these companies fail to maintain their momentum, the resulting layoffs could lead to a downturn in consumer confidence and spending. Together, these factors create a precarious situation for Austin's real estate market, prompting investors to be cautious. Denver is facing several economic challenges that could signal a market crash in the near future. Rising interest rates are significantly impacting housing affordability, making it increasingly difficult for potential buyers to secure mortgages. As borrowing costs climb, demand for homes may decrease, leading to a potential slowdown in the housing market. Additionally, the construction industry, which has been a key driver of Denver's economy, may also experience a downturn as projects become less financially viable. This slowdown could result in job losses and reduced economic activity. Furthermore, a changing job market influenced by shifts in industries and remote work trends may lead to instability in local economies. These factors combined create a concerning outlook for Denver's real estate market, urging investors to proceed with caution. Chicago's economic diversification, while a strength, also presents vulnerabilities that could contribute to a potential market crash. The city's reliance on various industries, including manufacturing and finance, makes it susceptible to economic downturns in any one sector. Additionally, rising crime rates have a detrimental impact on business investments, as companies may hesitate to establish themselves in areas perceived as unsafe. This reluctance can stifle growth and lead to job losses, further exacerbating economic challenges. Moreover, Chicago has been experiencing a population decline, which directly affects the housing market. As more residents leave the city, demand for housing decreases, leading to falling property values. These combined risks create a precarious situation for Chicago's real estate market, making it essential for investors to remain vigilant. Phoenix is witnessing rapid growth in its housing market, raising concerns about a potential bubble. While the influx of new residents has driven prices up, this unsustainable growth could lead to a sharp correction if demand falters. Additionally, water scarcity poses a significant threat to the long-term sustainability of the region. As climate change exacerbates drought conditions, the availability of water for both residents and businesses may become increasingly limited, impacting economic stability. Furthermore, fluctuations in the job market can create uncertainty for local economies. If key industries experience downturns or layoffs, consumer confidence may wane, leading to decreased spending and investment. These economic indicators suggest that Phoenix's real estate market could be at risk, prompting caution for potential investors. Las Vegas faces several risks that could lead to a market crash, primarily due to its heavy dependency on tourism. The city's economy relies significantly on visitors, and any downturn in travel, whether from economic recession or global events, can have immediate and severe implications. Additionally, the volatility of the entertainment industry poses a risk. Shifts in consumer preferences or economic conditions can lead to sudden declines in revenue for hotels, casinos, and related businesses. Furthermore, the potential for overbuilding in the housing market raises concerns about supply outpacing demand. As new developments continue to emerge, the risk of a housing surplus could drive prices down, impacting property values. Together, these factors create a precarious economic environment for Las Vegas, urging investors to approach with caution. In summary, we've explored the top 10 cities facing potential market crashes, highlighting key economic risks such as industry volatility, rising living costs, and housing market imbalances. Each city presents unique challenges, from San Francisco's tech dependency to Miami's climate concerns, emphasizing the importance of understanding local dynamics. As an investor or homeowner, staying informed about these market trends is crucial for making sound decisions. Remember, knowledge is power when navigating the complexities of real estate. If you found this video insightful, we encourage you to subscribe to our channel, like this video, and share it with others who may benefit from these insights. Together we can stay ahead of the curve and make informed choices in an ever-changing market landscape.